financial statement analysis is important. Suppose a company requests for credit facilities to a bank. You see, the company will submit past 3 years audited reports to the bank. Annual reports also company will submit. And then bank will also like to have from the company 3 years, you see, futures, projected balance sheets. Now bank, up till now bank company was, you see, running by its own funds. Now company wants to borrow money from the bank, and the company is expanding the business. So by studying the past, you see, balance sheets, financial data, bank will find out how is the sales, you see, whether the sales are increasing or not, how is the profit, whether the profit is increasing or not, about current ratio, current assets divided by current liabilities, then debt equity ratio, what was the debt and what was the equity. Then if the company is also taking term loan for buying any machinery, then bank will, you see, calculate debt service, you see, ratio, just to see whether company will be in a position to service the EMI. So it is very important. Now, annual reports, you see, every year after the financial results, and you see, company gets the balance sheets audited from the chartered accountant, and then auditor also gives its report. Then company, you see, takes out this annual report, you see, how was the performance of the last year, and company also does the comparison with the previous, you see, years. Now then comparative, common size, and trend statements, you see, also company finds and see what is the trend, whether the, you see, sales are increasing or not. Then ratio analysis also, company does ratio analysis also. Company finds out current ratio, that is very important, current assets divided by current liability. Then debt equity ratio, you see, how much is the debt and how much is, you see, company's own stake. Then company finds out debt service coverage ratio. If suppose company borrows term loan, will it be in a position to, you see, service the EMI without any difficulty? Now, financial statement analysis is a critical aspect of accounting for managers. You see, as it provides insights into the financial health, you see, what is the financial health of the company, whether the company is in a position to meet out its short-term liabilities, then how is the performance, you see, how is the sales, whether sales are increasing or not, and stability, the company will be, you see, stable or not of an organization. Financial statement analysis is an essential tool, you see, for managers to gauge the financial health of their organization, you see, guide strategic, you see, decisions, you see, and communicate with stakeholders, those who have invested money, you see, they will also like to know about the dividend, about their, you see, investment, about the company's affairs. Now, next is, you see, decision making. You see, managers use financial statement analysis to make informed decisions regarding investments. You see, how much investments are fetching interest, whether those investments are, you see, good, or company should call back money from there and invest in other, you see, places, at other places. Then budgeting, you see, budget, you see, budgeted figures, is company in a position to achieve those budgeted, you see, sales, etc. And about, you see, strategic planning, you see, what is the planning, how company is going to proceed further. Then performance evaluation, you see, it helps assess how well a company is performing over time, and in, you see, comparison to its competitors. They will see the 5 years, you see, past results, and then they will take into account the results of other, you see, competitors also, and then they will do, you see, performance evaluation, they will compare. Then credit worthiness, you see, how rich is the company, it determines the ability of a company to meet its short-term, you see, and long-term obligations, which is crucial, you see, for securing loans or attracting investors. Like for a small borrower, if the civil report is not good, bank will not give the, you see, loan. Same way, you see, company also, whether in the past it has met out its short-term liabilities, it is, you see, paying the EMIs regularly, the account of the company is not, you see, NPA, all these things, this manager studies. Then next is income statement. You see, manager will study the income statement of the past few years, and you see projected, you see, income statements of, you see, future 2-3 years, shows the company's revenues, you see, expenses and profits over a specific period. Hence, it helps in understanding about the profitability of the company. Then next is, you see, balance sheet, assets and liabilities, provides a snapshot of the company's, you see, assets, liabilities, and owner's stake at a specific point in time. It is crucial for assessing, you see, financial stability. The company is financially stable, and you see, capital structure also, you see, manager will study. Next is cash flow statement. You see, inflow of cash, outflow of cash. That is very important. Details the inflows and outflows of cash, highlighting the company's ability to generate cash to meet obligations, you see, and fund operations. Next is statement of retained earnings. You see, how much earnings were, you see, retained, reinvested in the business. You see, shows the changes in retained earnings, which reflects the company's, you see, profit reinvestment over time. Then, you see, they do horizontal analysis, vertical analysis, and ratio analysis. Horizontal analysis, you see, involves comparing financial data over multiple periods. Comparison of financial data over multiple periods, say for the last 5 years, to identify trends and growth patterns. You see, what are the trends? How is the growth? You see. Then vertical analysis. Analysis each line item in a financial statement as a percentage of a base figure. You see, that is total assets or sales, helping to understand the structure of the financial, see, statement. They will assume one base figure, and then, you see, they will find out, you see, percentage of that, you see, base figure. Then ratio analysis, of course, we have discussed a little bit. Current ratio, debt equity ratio, debt service coverage ratio, uses various ratios to evaluate, you see, financial performance, such as liquidity ratios. Means these ratios measure the company's ability to meet short-term obligations. How liquid the company is, how liquid the funds are to meet short-term obligations. That is current ratio, quick ratio. Next is profitability ratio. Assess the company's ability to generate profit. That is gross profit, then margin, then return on assets. Next is, you see, leverage ratios. Evaluate the extent of a company's, you see, financing through debt. That is debt to equity ratio. Debt to equity is, you see, debt divided by equity. And it is preferred in the banks. They say that, you see, 3:1 is okay. If it is beyond that, we will not, you see, finance. Then next is, you see, efficiency ratios. Measure how effectively the company uses its assets. That is inventory turnover. Then, you see, asset turnover. You see, what is the cycle? You see, suppose let us start from raw material. You see, company gets the raw material, company converts the raw material into the finished products. Then companies, you see, sell this, you see, finished products. And many people, you see, they will like to have from the company 45 days, you see, credit, 60 days credit. They will not pay. immediately. Of course, some of them may pay immediately also. In that case, company will give them discount also. So till the debts are realized, this is, you see, one production cycle, starting from purchase of raw material to till, you see, debts are realized. Normally it takes, you see, three months. So we can say that in a year, 4 times, you see, companies, you see, producing the goods, and accordingly, you see, we'll calculate how much, you see, inventory is required in one cycle. Next is strategic planning. By understanding, you see, financial trends and ratios, managers can make, you see, better strategic, you see, decisions. Then, of course, risk management is very important. Financial analysis helps in identifying potential financial risks, you see, enabling proactive, you see, management. Next is resource allocation. It helps in deciding how to allocate the resources efficiently to maximize returns. Now, how returns will be maximized? When, you see, production will be maximum, you see. So resources are used in such a way to give, you see, maximum, you see, production. Then stakeholder communication. Clear financial analysis, you see, enables managers to communicate the financial health of the company to the stakeholders like investors, creditors, and employees. You see. So managers will tell them about the financial health of the company, whether it is having, you see, strong, weak, you see, health. About health means, you see, about financial condition. You can say financial condition of the, you see, company. Next is subjectivity. Different, you see, accounting methods can lead to different interpretations. Same data, external factors, economic conditions, industry trends, and, you see, regulatory changes can affect, you see, financial performance. Sometimes making historical, you see, analysis less predictive. Then complexity, understanding and interpreting the vast amount of data can be, you see, challenging, you see, especially for managers without a strong, you see, accounting background. If the accounting background is strong, then he can understand. Otherwise, you see, it will be difficult for him. It will be challenging for him. Now, understanding annual reports. Just now we discussed, you see, 31st March, you see, the financial year closes, 1st April to 31st March. After this, the company will, you see, prepare its balance sheets. Then after preparation of the balance sheets are audited by the chartered accountant. Then after that, you see, banks, you see, they prepare the annual report. And understanding an annual report is a crucial part of financial statement analysis. An annual report provides a comprehensive overview of a company's financial health. You see, annual report will tell us about the financial health of the company, about the, you see, operations of the company, and what are the future, you see, prospects, you see, so that if a investor wants to, you see, inquire about his funds invested, or if he wants to make a fresh investment, or if he wants to suggest to his, you see, or his friend about investment in that particular company. So if he is aware of the future prospects, then definitely, you see, he will do that. And now, for example, any company, you see, which is thrown by this Reliance, people are, you see, confirm that that company will make profits and it will fetch them good dividend. Now, what is the purpose of annual report? The annual report is a document prepared by public companies to communicate their financial performance, business operations, and other key information to shareholders, then potential investors, and government regulatory, bodies. Then regulatory requirement. In many countries, publicly listed companies are required by law to publish an annual report. In many countries, publicly listed companies, public limited companies, are required by law to publish an annual report, whereas it is not applicable to private limited company. Private limited company, only two directors, two people. If they contribute in our country 1 lakh rupees both together, they can start a private limited company. It is very easy to form a company and open a bank account. They will take this GST number. They can take GST number. After opening, deciding the name, they can request for this particular name to the registrar of companies. Then they can submit memorandum of association, articles of association to registrar of company. And register, they have to send one, one address where they will be conducting each year annual general body meeting. That is the registered office address of the company. That should be noted down in the registrar of companies. We are having registrar of companies office state-wise. All the states are having one registrar of companies office. So the companies which are formed in that state, they have to apply to that particular state ROC, registrar of companies. Registrar of companies is going to issue them the certificate that they can start the company. We have already discussed, if it is a private company, only two people, they will join together. Minimum capital required is, 1 lakh rupees, 50,000 each. They will contribute, and then they will think about the name of the company, and they will ask from the registrar of companies whether that name is vacant. Anybody else is running that company by that name. So our ROC will give them, registrar of companies will give them permission. Yes, you can start a company with this name and note it down. So then they will prepare article session and other documents which are required to be sent to ROC, and they will ROC register their company. After registration, they can apply PAN. They can obtain PAN number in the name of the company. Then with the PAN number and registrar of company will issue them a certificate of incorporation of the company. So by both these, they can open a bank account, and start doing the work. Whereas in public limited company, they have to collect money first from the public. Say for example, Reliance, they are starting a new company. So they will take permission from the ROC, submit the relative papers. Then you will find in the newspaper, they will give advertisement, and they will collect money from the people by issuing the shares to the people. So in that advertisement, they will write everything. And then whosoever wants to invest, make an investment in this new company or land. So they will fill the form and attach a check, application money. When you buy a share, this application money will be there. Then allotment money you have to submit. Then first call, final call. So you have to pay to land these money in 4 stages. So then when after this, when the money is collected by the company, then they can, ROC will allow them to start the business, to start the company. So regulatory requirements, one has to, fulfill. And then every year, this public limited company, they have to, publish their annual report, which contains the, financial performance, then business operations, and other key information, to stakeholders, potential investors, and regulatory bodies, and other key information required by these three, bodies. And the balance sheet also, they publish balance sheet, profit and loss account, they publish in the, annual report. Next is, chairman, chairman, or, chairman's letter, or chief executive officer, CEO. He gives his message in the annual report. Now, the purpose is provides an overview of the company's performance during the year, then strategic, initiatives, then market conditions, and the future, and the outlook for the future, how well the company is going to do in, future. That is very important. Then analysis tip, look for, insights into management's, vision, leadership style, and the company's response to the challenges. What were the challenges faced by the company? How company is going to, do that. Then business overview. Now, purpose, describe the company's business model. Products. What are the products or what are the services the company is giving? Markets, and about the competitive environment. Who are the competitors of the company? Then analysis tip, understand how the company generates revenue and what competitive, advantages it may have. Then management's decision and analysis. Purpose offers, management decision analysis offers a, detailed discussion of the financial statements, including revenue, expenses, how the expenses can be curtailed, profitability, how the profit can be increased, and cash flow, cash coming in the company, cash going out of the company. It also covers the risks. What are the risks, what are the opportunities, and what are these. Next is analysis step, pay close, attention to management's, explanation of financial results. Any significant changes from previous years and forward-looking, statements. Now, few years back, that COVID year, people, lost, lot of money. There they had suffered, heavy losses in businesses also. But now that period has gone. Now they have recovered. Now, financial statements. Financial statements are, balance sheet showing liabilities on the left side and assets on the right hand side. Liability is current liability, long-term liability, then equity, or equity, current liability, long-term liability. And under assets, current assets and fixed assets. Next is, income statement, profit and loss account, we'll come to know net, profit by this. Then cash flow, statement will shows from where the company received the cash, and how much company paid, to whom company paid, inflow and outflow of cash. Inflow and outflow of cash. Balance sheet purpose provides a snapshot of the company's financial position at a specific, point in time, showing assets and liabilities and shareholders' equity. So balance sheet normally in our country, it is easy as on 31st March of that respective year. We always prepare on the last day of the, accounting year, the entire years, will show how much profit, company made in the profit and loss account. Detailed, expenses will come. Detailed, incomes will come. And in balance sheets, liability and assets are there. Now, next is analysis, tip. Now, what is the purpose of balance sheet? Just to see this, compare, the items in earlier, balance sheets, and whatever are the projections, whatever is the projected data. So just to confirm that they will be in a position to achieve those projections. If those projections, say sales projections, then they have to, mention there how they are going to achieve those, sales, projected sales. Then analysis tip, assess the company's liquidity solvency. Assess the company's liquidity. How liquid is the company? Current liabilities, is the company meeting out without any problem? Then solvent, solvent, and capital structure, about the capital. By analyzing ratios like the current ratio is current assets divided by current liabilities. Debt equity ratio is debt divided by equity. And return on, equity, how much is the equity and how much, is the profit. So that is return on equity. Next is income statement. Shows the company's performance, financial performance over a period, including revenue, items, expenses, and net income. Now, evaluate profitability by looking at margins, then gross profit, operating profit, and net profit. Revenue growth, and expense management, how to, manage these expenses. Next is cash flow statement, inflow of cash and outflow of cash. Details the cash inflows and outflows from operations, from operating, investing, and financial activities. Now, next is analysis tip. Focus on the operating cash flow to assess the company's ability to generate cash from its core, business. Free cash flow is also crucial as it indicates the cash available, after capital, expenditures. After doing capital expenditure, still the company is having cash. Now, what are the notes to the, financial statement? In the notes, we provide the purpose and the analysis tip. Now, purpose provides additional details and context to the financial statements, including accounting policies, contingent liability. It may happen, it may not happen. Suppose bank is, given a guarantee, issued guarantee to a customer. Now, customer requested the bank to issue a guarantee in favor of his landlord, who says that I want a guarantee. If you will not pay the rent, the bank will pay. So you get a guarantee from the bank. So the person, wherever he is having account, he will go to that bank. Suppose he is having FD also in that bank. So bank will issue a guarantee in favor of landlord. Bank will write in that guarantee that Mr. So-and-so, landlord of Mr. So-and-so, property address. And then bank will, write that if the tenant doesn't pay the rent, we will pay the rent. Then there is a special language for, these guarantee issues. So bank will give such a type of letter, and when it goes to the beneficiary, now he's happy. He knows that my rent, if the tenant is not paying, bank will pay. So provides additional details and contents to the financial statements, including accounting policies, contingent liabilities. So this liability, this guarantee issued, it is a current contingent liability for the bank. So it may, it may invoke or not. The person in whose favor guarantee is issued, he may demand the money from the bank or not. Because the purpose for which guarantee is issued, if suppose there is no problem, there is no complaint, so that person will not invoke the guarantee. Invoking the guarantee means rank that you said that if he doesn't pay the rent, you will pay, so he is not paying, now you pay the rent. So this is a contingent liability. Similarly, LC, letter of credit, that is also, uh, in export transaction, suppose in India that exporter is export 10,000 shirts to USA. The importer in USA, the exporter says that you send the LC from your bank. So the importer asks his bank to issue a LC in favor of the exporter, that if the order is met as per the details mentioned therein, the bank takes the responsibility of payment if the importer is not paying. So by this, he will be sure of receiving the money. And then segment information, other information, then analysis tip, read these notes, carefully to understand the assumptions and estimates, estimates used in, financial reporting, and any, potential risks also. So they will mention about the bad debts also. If any amount is written off, they will mention that also. Sometimes in the return of accounts, recovery also comes. So that goes straight to the profit and loss account, because the account is already written off. Bank has already, whatever was the balance outstanding, bank has made it zero, written off to the debit of profit and loss account. So now, if there is any recovery, but bank keeps on following up for the bad debts. Because in many cases, bank is having the security, the property title deeds are with the bank. So bank will keep on following with that customer who did not pay, and bank will return the, bank will, recover the money. Bank will recover the overdue EMIs. Now read these notes carefully. So in that they will mention how much is the NPA of the bank, how much is the standard assets, how much, suppose it is a bank's balance sheet, how much is the, doubtful assets, how much is substandard assets, how much is loss assets. Normally bank writes off the loss assets. Every year bank writes off just to clean the balance sheet. Bank does its balance sheet clean by writing off, this unrecoverable, loans. So read these notes carefully to understand the assumptions and estimates used in financial reporting and any potential risk. Then auditor's report, yes, very important, an independent opinion on the, accuracy and fairness of the financial statements. That is, auditor's report. Analysis tip, ensure the auditor's opinion is, unqualified. Any qualifications or emphasis of matter should be investigated further. If suppose there is any qualification, then that should be further investigated. Next is corporate governance report. Purpose describes the company's governance structure, including the board of directors, executive, compensation, and shareholder rights. How much compensation was given to the executive. Then what are the rights of the shareholders, company's governance structure, including the governance structure of the directors. Then analysis tip, strong corporate governance is a sign of a well-managed company. Look for transparency, board independence, and alignment of management's interest with those of, shareholders. Next is sustainability, sustain and corporate social responsibility, CSR, corporate social responsibility report. Purpose is outlines the company's efforts in sustainability, environmental impact, and social responsibilities. Analysis step, consider how these initiatives may impact the company's long-term strategy and, a reputation. Shareholder information, in annual report, shareholders information is there. Purpose is to provide details on stock performance, dividend policy, and major, shareholders. Then analysis, review dividend policies, stock performance trends, and ownership concentration to understand, shareholder value creation. Now, next is analyzing the annual report, trend analysis, compare the current year's financial data with previous years to identify the trends in revenue. You see whether revenue is, increasing or it is decreasing, expenses, whether expenses are increasing or decreasing. If they are increasing, why they have increased, their profitability increasing or decreasing, and other key, metrics, other things which are very important. So you have to do trend analysis for them also. Then ratio analysis, calculate financial ratios, that is profitability, liquidity, solvency, and efficiency ratios to assess the company's performance and financial health relative to industry, benchmark. Then peer comparison, compare the company's financial metrics with those of its competitors, to evaluate relative performance and market position. If they are doing well, how they are doing well, Then qualitative, assessment, assess qualitative, factors such as, management quality, business strategy, industry dynamics, and potential risks that might not be, fully captured in the financial statements. Risk assessment, that is also very, important. Risk assessment and risk management, then how to manage, how much is the risk and how to manage it. Identify and evaluate the risk mentioned in the report, such as market risk is there, credit risk is there, operational risk is there, and regulatory risk is there. And consider, their potential impact on company's future, performance. Then inconsistent, accounting policies, changes in accounting policies or unusual accounting practices may be a sign of earnings management or financial manipulation, window dressing. Now, for example, a bank, suppose a customer has not availed the limits. So bank tells them, that you avail the limit full. So whatever, and then you give us deposit also. So that is what is window dressing. Declining cash flows, company with growing revenues, but declining operating, cash flow could be facing operational inefficiencies or accounting issues. High debt levels, excessive leverage can be risky, especially in periods of economic downturn or rising interest rates. Negative auditor's opinion, any qualifications. If auditor has, pointed out our mistakes or negative remarks should be taken seriously. We have to improve. Then understanding an annual report requires a combination of quantitative analysis through financial statements and ratios and qualitative assessment, management decision, market position, and risk. By carefully analyzing the annual report, you can gain valuable insights into the company's financial health, operational efficiency, and future prospects. This analysis is essential for making informed investment decisions or evaluating the company's performance. Next is methods used in financial analysis. Financial statement analysis involves, evaluating a company's financial statements to understand its financial health, performance, and trends over time. Three key methods used in financial statement analysis are comparative analysis. You have to compare, common size analysis, and trend analysis. Comparative analysis involves comparing financial statements from different periods, usually year over year, to assess changes in financial position and performance. It can also involve comparing a company's financials with those of industry peers or competitors. Then purpose helps identify significant changes, growth trends, or warning signs in a company's financial performance. The next is process. Select the financial statements for two or more periods. Place the statements side by side for easy comparison. Calculate the difference in absolute terms and percentage change for each line item. That is revenue, expense, net income. Identify and analyze major increases or you see decreases. Why, say for example, why the sale has reduced? Why the sale is reduced? What is the reason? Common size analysis involves expressing each line item in the financial statements as a percentage of a base figure, such as total sales or total assets. This method standardizes financial statements, allowing for easier comparison across different periods, companies, or industries. Purpose allows analysts to compare the relative proportion of financial statement items, removing the impact of size differences between companies. Then process. In the income statement, express each item as a percentage of total revenue, that is cost of goods sold, as a percentage of sales. In the balance sheet, express each item as a percentage of total assets or total liabilities and equity. Review the percentage to analyze the structure and efficiency of the company's operations. Trend analysis, you see, involves examining financial data over multiple periods to identify patterns, trends, or long-term movements in financial performance. Purpose helps in forecasting future performance based on historical trends and identifying areas of consistent growth or decline. Process. Collect financial data for several consecutive periods, past 3 years, and future you see projected data of 3 years. Calculate the percentage change from one period to the next. Plot the data to visualize trends over time. Analyze the direction, magnitude, and consistency of trends, that is increasing revenues, decreasing profit margins. Comparative analysis focuses on changes between specific periods. Common size analysis focuses on the proportion of each line item related to a common base, facilitating comparison across companies or time periods. Trend analysis focuses on identifying long-term patterns over multiple periods. Each method provides a different perspective on a company's financial health, and they are often used together to gain a comprehensive understanding of the financial performance. So comparative analysis, common size analysis, trend analysis, you see, used together to gain a comprehensive understanding of financial performance of the company. Then ratio analysis and financial statement analysis. Ratio analysis is a key technique in financial statement analysis used to evaluate a company's financial performance and condition by comparing different financial statement items. Ratios can provide insights into a company's profitability, liquidity, efficiency, and solvency. Now, gross profit, you see, margin, gross profit margin is equal to gross profit divided by revenue into 100. Indicates what it indicates. It indicates the percentage of revenue that exceeds the cost of goods sold. Next is operating profit margin. Operating profit margin is equal to operating income divided by revenue multiplied by 100. It reflects the percentage of revenue remaining after covering operating expenses, excluding interest and taxes. It is not including interest and taxes, it is including interest and taxes. Net profit margin. Net profit margin is equal to net income divided by revenue into 100. Shows the percentage of revenue that remains as profit after all expenses, including taxes and interest. Return on assets, ROA. ROA is equal to net income divided by total assets multiplied by 100. Measures how effectively a company is using its assets to generate profit. Then return on equity. How much is the return on equity? Is the ROE is equal to net income divided by shareholders' equity into 100. Indicates how well a company is using shareholders' equity to generate profit. Then current ratio, very important ratio. Current ratio is equal to current assets divided by current liabilities. Measures the company's ability to pay off its current liabilities with its current assets. If it doesn't pay its current liabilities, this means the company's financial health is not all right. Next is quick ratio, acid test ratio. Quick ratio is equal to current assets minus inventories divided by current liabilities. Similar to the current ratio, but excludes inventory, which may not be as quickly converted to cash. Then cash ratio is equal to cash and cash equivalents divided by current liabilities. It focuses on company's ability to pay off short-term liabilities with its most liquid assets. Then inventory turnover ratio. Inventory turnover is equal to cost of goods sold divided by average inventory. Measures how many times inventory is sold and replaced over a period. Receivables turnover ratio. Receivable turnover, net credit sales divided by average accounts receivable. Assess how effectively a company is collecting its receivables. Asset turnover ratio. Asset turnover is equal to revenue divided by average total assets. Indicates how efficiently a company is using its assets to generate sales. Then next is solvency ratios. Debt to equity ratio. Debt to equity ratio is equal to total debt divided by shareholders equity. So it is a very important ratio. If the company applies for credit facilities to a bank, they find out this debt equity ratio of the past 3-4 years, and then for the future on the projections given by the company, bank finds out debt equity ratio of futures years also. Then similarly current ratio also, if a company applies for credit facilities, bank is going to see current ratio of the past 3 years audited balance sheets and future projected figures also. On projected figures also bank will calculate the current ratio. So if it is 1.3:1, bank will go ahead. Bank will look into sanctioning of credit facilities to the company. And similarly debt equity ratio, if it is 3:1, 2:1, it is okay. If it is more, then bank will not sanction credit limits to the company. Now debt equity ratio compares a company's total debt to its shareholders equity, indicating the proportion of debt used to finance the company's assets. Debt ratio is total debt divided by total assets. It measures the proportion of a company's assets that are financed by debt. Then next is interest coverage ratio. Interest coverage ratio is equal to operating income divided by interest expense. Assess how easily a company can pay interest expense on outstanding debt with its operating income. The next is price to earning, PE ratio. Price to earning, how much people who are the shareholders are going to get dividend. Price to earning ratio is equal to market price per share divided by per share. Measures the investors are willing to pay per dollar of earnings, reflecting the market's expectations for future growth. Earnings per share is equal to EPS, is equal to net income minus preferred dividends divided by average outstanding shares. Indicate the portion of a company's profit allocated to each outstanding share of common stock. Next is market ratios. Dividend ratio. Dividend ratio is equal to annual dividends per share divided by market price per share into 100. Shows the return on investment from dividends expressed as a percentage of the share price. Next is importance of ratio analysis. What is the importance of ratio analysis? For management point of view, they will now by current ratio only. If it is 1.3:1, it is a good ratio. So current assets divided by current liabilities. Then if it is debt equity ratio, debt divided by equity. How much are the borrowed funds divided by how much is the equity. Performance measurement ratios allow analysts and investors to assess a company's past performance in the past, how the company has done, compare it to peers or industry benchmarks. See what are benchmarks for these industries. You see what are the figures. The competitors, what are the figures of the competitors? So they study that. Accordingly, they correct wherever they are lacking. You see, they correct that. Then next is you see trend analysis by calculating ratios over multiple periods. You see, one can identify trends where the trend is going and predict you see future performance. How is going to be the future performance? The trend is this. Decision making, you see, ratios provide crucial information for managerial decisions, such as whether to expand, invest in new projects, or cut short. You see, whether the existing project should be, you see, expanded or not. Then comparative, you see, analysis. Ratios facilitate comparative comparison between companies of different sizes, making it easier to evaluate, you see, relative performance. Next is risk management. Ratios help in assessing the risk of investing in or lending to a company by evaluating its financial stability and operational, you see, efficiency. If you want to increase the capital, if you want, you see, people to invest money in the company, so those people will see the results, you see, then and only then they will, you see, invest the money in the company. So we have studied, you see, importance of ratio analysis. Now, what is the importance? You see, performance measurement. Ratios allow analysts and investors to assess a company's, you see, past performance, comparing it to peers or industry benchmarks. Trend analysis by calculating ratios over multiple periods. You see, one can identify the trends. You see where the sales is going, and predict future, you see, performance. So by seeing the past, you see, in the future this is going to, you see, happen. Then decision making. Ratios, you see, provide crucial information for managerial decisions, you see, such as whether to expand, invest in new projects, or cut, you see, cost. You see how to cut the cost so that, you see, profit can be, you see, increased. And you see, if we are going to expand, you see how much, you see, we should increase the production. You see, it is before the break-even point, you see, reaches. And so all these things, you see, it helps in the for the managers to take decisions. You see, next is, you see, comparative analysis. Ratios facilitate comparison between companies of different, you see, sizes, making it easier to evaluate, you see, relative performance. You see, you can compare, you see, your results with the, you see, results of, you see, other company. For example, now banks, you know, they compare their performance with their another, you see, bank of, you see, same size. They will compare, you see, and then wherever they did not do well, suppose in one bank, you see, CASA, current account and saving account, that is the most, you see, lucrative for the bank. So CASA is, you see, more, naturally that bank will make, you see, more profit, because CASA, by CASA, current account and saving account, bank is, you see, in current account, bank is not paying any interest to the customers. In saving bank account, bank is paying just 4% interest to the customers. Same money bank is, you see, using it for giving loans, you see. at 8%, 9%, 10%, 11%. So naturally, the bank which is having, you see, substantial amount of CASA deposits, it is going to, its profit will be more compared to a bank who is having, you see, less CASA deposits. So the bank which is having less CASA deposits will try to evaluate how, you see, that bank can increase its, you see, CASA figures so that its profit will also increase. Then risk assessment ratios help in assessing the risk of investing in or lending to a company by evaluating its financial stability and operational, you see, efficiency. Then in conclusion, you see, ratio analysis is a powerful, you see, tool in financial statement analysis, offering insights into various aspects of a company's financial health and performance. It helps stakeholders, you see, make informed, you see, decisions based on, you see, quantitative, quantifiable, you see, data. So main ratios which we studied, you see, are, you see, current ratio. Current ratio we find out by dividing, you see, current assets with current liabilities. You see, preferably it is 1.33:1. So then bank will go ahead for, you see, giving loans to the company. Then next ratio which bank sees is, you see, debt equity ratio. Debt equity ratio is debt divided by, you see, equity. So it is preferably, you see, 2:1, between 2 and 3:1. If you see debt is say 4:1 and more, bank will not provide, you see, credit facilities to that company. Then for term loans, servicing of EMI of a, you see, term loan, bank finds out debt service coverage ratio. And by that, you see, bank will come to know that this particular company will be in a position to, you see, service the EMI. And then, you see, up to 5 crores of credit facilities, you see, banks are considering turnover method. The bank sees the sale of the company. You see, suppose, you see, company has, you see, done 2 crores, you see, sale as on 31st March 2024. During the financial year 1st April to 31st March 2024, company sales were, say, 2 crores. And in this particular year, starting from 1st April 2024 to 31st March 2025, now company is, you see, saying that we will be in a position to do sales amounting to 2 crores 20 lakhs. So, and in the next financial year, suppose company says company will do 2 crores 40 lakhs. So every year company feels that they will be in a position to increase their sales by, you see, 20 lakhs, which is reasonable also. And if in the past also the trend is of the companies, you see, same companies increase their sales, first 10 lakhs, then you see 12 lakhs, then 14 lakhs, then you see 16 lakhs, then 18 lakhs, then you see 20 lakhs. Now bank is, you see, assisting limits. Bank is providing credit facilities to the company. So bank sees the sales, and you see, bank can lend up to, you see, 20% of sales to the company. Now suppose company has predicted that 31st March 2025, you see, company will do 2 crore, you see, 20 lakhs. So now bank will, you see, give 20% of the sales. You see, 20% of the sales will be to 20 lakhs. 20% of it will be, you see, bank can give about, you see, 40 lakhs or 44 lakhs credit facilities to the company. That is working capital limits. Working capital limits, bank can sanction 20% of the sales. If suppose one company's sale is, you see, 1 crore, bank can give, you see, 20 lakhs, you see, working capital limit, and 5 lakhs, you see, company has to introduce. It is going to be margin. Company has to contribute from its own, you see, funds. So students, ratios are, you see, very important. So we are concluding the session. Students, thank you very much.